Hi, it's Lee, and welcome to the Tesla Economist. The automotive industry is cyclical, meaning that in a recession, demand drops quite significantly. Generally, most automotive manufacturers cut down on production to meet demand. They have little choice when each vehicle they sell makes no profit. If they wanted to keep the same supply as before a recession, then they would have to reduce prices to meet the new demand. But when you sell millions of a product, and they cost tens of thousands of dollars, then reducing the price by, say, $5,000 means, well, probably over $10 billion less profit coming in. That's a huge amount, and not sustainable. So vehicle production drops to meet demand. Now, if Tesla was also a part of this automotive industry cycle too, then demand for Teslas would also drop. Firstly, there isn't really much sign of that, perhaps other than in a developing nation where not that many people can afford Teslas. And if they really want an electric car, there is a plethora of other much cheaper EVs available to them. Yes, China is a large EV market, but not necessarily a large market for Tesla, unless perhaps Tesla start offering a low-cost compact. Then Tesla will absolutely own it, undercutting every other Chinese EV in price, while still offering so much more, which sounds inevitable. As for other markets, Tesla may not need to reduce prices, and even if they did, they're expanding production for a lower cost Model Y anyway, using Tesla in-house cells, implying that even if Tesla had to reduce prices in Europe or US, they're in the process of reducing costs substantially anyway, that would more than make up for any price adjustments. We hear that the 4680 will be at $70 per kilowatt hour, perhaps about 30% less than what Tesla are paying for LFP. However, LFP sells way more, so although they may be lower cost per kilowatt hour, you end up needing more of them to get the same range. So in my opinion, a better cost measurement is dollars per mile of range, and the 4680s are probably closer to 40% lower cost than LFP there, where it matters the most. But it doesn't stop there, of course, as there is the structural battery pack too, which further reduces weight again, and thus cost. Except these 4680 Model Ys are not LFP standard range rear-wheel drive versions. They're going to be longer range all-wheel drive, and from the reviews I've seen, they are outstanding. Okay, the second motor will add to cost compared to the standard range, but that may be about it. And yes, let's be honest, the locally sourced components, labour and energy are likely all lower cost in China too, when compared to Berlin. But with so much vertical integration and automation, it matters less. And when you add all these factors in, I would say there's a good chance a Berlin 4680 Model Y could be reduced for a lower cost than a Model Y rear-wheel drive in Shanghai eventually when it's ramped up. Even more likely in Texas, and definitely if you include subsidies, and then obviously if you include tax credits. So what does this mean? It means that the new and future factories of where Tesla manufacture their vehicles, which, by the way, will likely be over 80% of all vehicles Tesla produce by around 2030, well, they will all be able to produce a Model Y for as little as about $30,000, or possibly even less. And of course, when that 4680 chemistry is refined, we're looking at around mid 300 miles with that. And yes, of course, Tesla are not just going to keep making Model Y factories. They will bring out some new models too. I just mentioned this as it is indicative and can be compared to what we have now. The point is though, we do have two new factories that make Model Ys, and will likely get costs down to low $30,000 per vehicle. Yet these will be superior to the current Model Y rear-wheel drive, which I believe is also around the low 30s of cost of goods sold per vehicle. And that's with a strong dollar. It would be less if the dollar was weaker. Tesla's new 4680 Model Ys are not just lower cost, they're obviously a superior vehicle, vastly superior to the rear-wheel drive version, but likely superior to the 2170 long-range versions too. They definitely handle and drive better. We know they have the same performance. It was a software upgrade Tesla offered, but then took away. But they gave us a glimpse, nonetheless, of what these cars can do. And likely the range will eventually catch up with the 2170 version soon enough. But all I'm trying to say is that they are a lot more valuable than a rear-wheel drive version, and likely closer to a 2170 long-range price point. And we've seen them at $60,000 already. Now, I don't think they're close to $30,000 in cost yet, but by the end of next year, if the ramping goes as well as Elon is suggesting, then it could be mid-30,000s. I would expect a margin of around 35 to 40%, perhaps by close to the end of next year. Therefore, if Tesla had to lower their prices to meet demand, this gives them so much more buffer in order to do so. The thing is, Tesla's demand is more elastic than an ICE vehicle. So if an equally priced BMW, for example, lowered their price by 10%, and Tesla did also, then perhaps the BMW demand increases 20%, but the Tesla demand might increase 40%. Except, as we know, BMW or ICE cars can't afford to lower their vehicles by 10%, as they don't have this margin buffer. And if they lowered their price by $4,000 per vehicle, and if they sell 2.5 million a year, that's $10 billion a year less profit or loss. Instead, they cut back on production and closed lines. If the global financial crisis was anything to go by, I would guess some legacy auto production may end up being about half what it was previously. When we also factor in the electric car competition, that means that their OPEX per vehicle would pretty much double, which means they are still losing more money on their sales. There's a high possibility a lot of legacy companies will need to raise their prices and adjust supply for the new demand at these higher prices, probably by closing down models, whilst Tesla has the ability to lower their prices. Another potential scenario where we see legacy running into serious issues. We've played out a lot of scenarios, and we have yet to find one where it goes well for legacy. And I'm really just referring to Giga Berlin or European sales. In the US, Tesla's largest market and home turf, they have an even larger buffer with battery subsidies and tax credits. There's no reason to lower prices in the US, but potentially a reason to raise them even. And like I said, the US is Tesla's biggest market with the most potential. The US is the world's largest auto market by dollars, even bigger than Europe with the highest ASPs, and where Tesla is based. They also have the most advanced FSD there and will continue to always be the furthest ahead. Tesla can become the biggest company in the world with the US as its only market. Of course, it has Canada next door too. Yes, the lower cost Model Ys are going to be hugely profitable and very popular, but we're still talking likely in excess of $60,000, even when the ramping increases dramatically. This cuts out so much of the market at these higher prices, for lack of a better word. Remember all the associated savings and conveniences that accompany a Tesla though. But still, if you can't physically obtain the funds, then you can't buy it. And the likelihood is the used Tesla market isn't going to help much either. But after 3 or 4 million Model Ys, that might truly be where the market saturates. And Tesla still has a lot more growth to go. I wonder if there'll be a lower cost version of a 4680 Model 3, but part of me thinks that's Tesla looking too much in the rearview mirror compared to what they've learned since. It's all about manufacturing. They've created this product that can get people from A to B at unbeatable costs, at least compared to just about any other form of private road transport. That is one of the most valuable aspects of this company, except it's being hidden with a high cost of initial purchase. When the purchase price reduces, the affordability of the entire product starts to unfold and becomes exponentially more affordable. Forget about design. Find a way to manufacture a vehicle for as low a cost as possible, whilst also being able to ramp the production as fast as possible with the most units produced per minute. I say per minute rather than squared foot, as I think it's more about time than space. Although, knowing Tesla, it will likely also be the most number of units produced per square foot too. And this is what the Cybertruck is, a new way of manufacturing. Design the car around the manufacturing process first. What is the fastest, lowest cost way to manufacture a vehicle? Oh, wow, like that, and it costs just that much, and we can make that many a minute? Wow, that's amazing. Then they see what the result looks like. They can do what they can to alter it slightly to make it look as appealing as possible without compromising the manufacturing, but at the end of the day, the future vehicles will be about getting costs down and manufacturing speeds up, then design after that. But this is basically for the exterior and structure we're talking about. The interior will have comfortable seats, great stereos, and a huge screen with a plethora of apps and entertainment. Yet somehow, I'm sure the car will still look cool, especially when it's reinforced with the Tesla brand. And perhaps that's what the Cybertruck really was, a way for our eyes to start to adjust to the future of private transport. And we may expect this new platform to look more like a cyber compact. And will consumers even care if they can own a Tesla for just $25,000 or $30,000 and have to pay barely anything on charging? They still get all the Tesla features and will likely have a great performance or the option for it. Same with range. If you want a Tesla at this lower cost, then that's what it'll be. Elon's saying they've reduced production costs by half. Well, I tell you now, a car that costs half as much to produce as a Model 3 will not look anything like a Model 3. A Tesla maybe make only $10,000 to $15,000 per sale on this vehicle, perhaps half as much compared to the Model Y, but they sell a lot more, assuming it is sold for the public. However, it also means there are more people using it that are able to subscribe to all the software in the car, which is where the real money is. FSD alone at $200 a month after 20 years is around $50,000, pretty much all profit. Much more than Tesla make on a Model Y. Overall though, my point was that people are looking at Tesla's products in the past, and what if they have to lower their prices on those? Their future products will cost less to produce, which means there's more margin there anyway if they have to lower prices. It's just the competition that needs to be concerned, not Tesla's stockholders. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.